Welcome to Accounting with Madam Mombi. In this tutorial, I am going to be covering the accounting theory, that is, the accounting principles, concepts, assumptions that guide how accountants should undertake accounting, or rather, the conceptual framework of accounting, which is a guide on how accounting should be done. So to start with, we are going to look at the accounting assumptions. These are the assumptions that underlie the development of financial statements. And the first one is the going concern, or what we call continuity. Now, when we talk about going concern, when you start a business, what is your intention? Do you plan to liquidate? Do you plan to cut your operations in the future? Definitely not. The plan is for the business to be here today, tomorrow, and the foreseeable future. Therefore, going concern on what we call continuity, it is the assumption that the business is going to be here today, tomorrow, and to the foreseeable future. It has neither the intention nor the need to cut the scale of operations. Now, why is it important for a business to be a going concern? It is based on this assumption that businesses are able to attract financing. Definitely, if you are going to get a loan of maybe 10 years, it has to be proven that your business is a going concern. It has the ability to be here today, tomorrow, and the foreseeable future, with no intention to cut or liquidate. So that is the first assumption that guides how accountants undertake accounting. It is a going concern concept, or what we call continuity. So the second one is time period assumption, or periodicity assumption. This is the assumption that the life of a business can be divided into artificial time periods for the purpose of financial reporting. What do I mean? I mean this, that a business is not it is not a live person. A business is not capable of being told to be alive in terms of the normal definition of human beings. But even then, we assume that a business has life, and that life can be divided into artificial time periods, exactly 12 months, 1 year, for the purpose of financial reporting. That is why we report after 1 year. We say trading profit and loss account for the year ended. 1 year. Balance sheet for the as at a certain date. That is the end of the year. The next one is the business entity assumption or concept. Now, it's good to note that if you start a business, the affairs of the business are separate and distinct from the affairs of the individual. And this is what the business entity assumption is all about. It is separating the affairs of the business from the affairs of the owner. Therefore, this concept says that, or states that the business is separate, distinguished, and distinct from the owners and from all other organizations, and from all other forms of businesses. That is the business entity assumption. Therefore, like if a sole proprietor, he takes some goods for personal use. Having taken the goods for personal use, we have to include them as part of the drawings, because the affairs of the business are different from the affairs of the business. The last one is the monetary unit of measure assumption. It is assumed that every business, the economic transactions can be measured in a form of unit, a monetary unit of measure. In Kenya, we use the Kenyan shilling. So we assume that all transactions that have to be recorded in accounting are those that are quantifiable. They are economic activities that can be measured by a monetary unit of measure, like I've said in Kenya, for example, the Kenyan shilling. Those are the assumptions that we make for them that are there that guide how accounting is done. The next ones are the accounting principles. we can have a look at historical cost principle. Now, historical cost principle it states that assets are recorded at their historical cost. That is, the amount of money that was given up to acquire them, or the amount of resources that were given up to acquire them. Why do we record assets at their historical cost? Number one, it is because it is verifiable. We can be able to see and check from the available documents at how much was an asset bought. This is opposed from the thought of maybe recording assets at their market value, which would maybe be higher, but assets in accounting are recorded at the historical cost. That is a principle. Now, if for example it is an asset like a motor vehicle, in later years you can charge depreciation. That is to reduce the cost of the asset and expense that depreciation as one of the expenses, but originally assets are recorded at their historical cost. So the next one is the revenue recognition principle. Maybe I would start this one with an example and ask that if you are employed and you go to work every single day, but you are paid at the end of the month, when do you say you earn your revenue? Do you earn your revenue at the end of the month when you get paid? Or do you earn your revenue every day as you go to work? Another question would be, if you are a shopkeeper and you sell goods on credit, a customer has come, they have asked for commodity, you have given them, but they have not paid. Do you recognize that you have made a sale or not? Or do you wait until you receive the money for you to recognize a revenue? So, this principle, that is revenue recognition principle, requires that revenue is recognized when earned, irrespective of whether cash has been received or not. So, I want us to differentiate two things here. Revenue earning and receiving of cash are two different things. Revenue is earned when you extend the effort. For example, in our first example, revenue is earned the day you go to work every single day. That is when you earn your revenue, every single day. For the shopkeeper, when he made the sale on credit and gave the commodity to the buyer, despite not being paid, he has earned the revenue. He has a right to receive the money of the goods worth. So what we say is that revenue is recognized when effort has been extended. Or rather, revenue is recognized when earned, irrespective of whether cash has been received or not. So you have to differentiate receiving of cash and earning of revenue. Those are two different things. The next one, we are going to look at the next one we're going to look at is accrual. And I want us to look at accrual together with matching principle, so that we look at them together because they are used together. Now, when we talk about, let's start with matching. Matching principle requires that all the expenses that were incurred to earn a certain revenue, they are matched together with the revenue. So, when you spend money in form of expenses to earn a revenue, you have to match the expenses and the revenue in the same time period. So if you incurred a certain expense in this period to earn a certain revenue in this period, they have to be matched or placed together in the trading profit and loss account. And this takes us back to accrual. Accrual is an extension of the revenue recognition principle that now looks at both sides, that is the revenue side and the expenses side, because accrual principle says that revenue is recognized when earned, irrespective of whether cash has been received or not, and expenses are recognized when incurred, irrespective of whether cash has been received or not. So this means that in any particular period, an attempt has to be made to make sure that you match the revenues earned vis-a-vis the expenses that were incurred in that period, so that in case there is any expense that was incurred, it has to be placed together with the revenue earned to determine the profit or the loss. So those two are discussed together. That is the accrual principle and the matching principle. The next one is the consistency principle. Now, consistency principle, it talks about making sure that similar items are treated in a similar manner from year to year. That is consistency, one perspective. The other perspective is making sure that the same accounting policies are applied from one year to the other. It is very important for there to be consistency so that comparability can be achieved. Now, what do you think about consistency? Imagine if the accountant was to choose a method of depreciation of his choice from year to year. That would mean that there is so much inconsistency in arriving at maybe the depreciation figure, and that would render the financial statements to be uncomparable, and there will be introduction of making the financial statements less relevant. So consistency has to be there, where similar items are treated in a similar manner, and also same policies are applied consistently over time from one period to another. That is the principle of consistency. So the next one is full disclosure. Now, as it says, or as it sounds, it talks about ensuring that the financial statements do not have omissions. Rather, the financial statements are, yes, they are complete in form of materiality. All aspects that need to be included are included in the financial statement. So, they're not only going to disclose when you are making a profit, even when you are making losses, there has to be full disclosure. And if something cannot be contained in the body of the financial statement, it has to be included in the notes to the financial statement. So full disclosure requires that all material and relevant facts are disclosed in the financial statement, either in the body of the financial statement or in the accompanying notes, so that if something is not in the body of financial statements, it is amongst the accompanying notes, but there has to be full disclosure. That marks one more. We have duality. Okay, we have substance over form. This is one of our other principles. Now I want you to imagine if a business buys an asset on hire purchase, or if a business takes a lease for a certain, probably machinery or a building. Now let's go with the hire purchase. If a certain asset in the organization is bought on hire purchase, we know that in hire purchase contract, the asset or the legal ownership, it is transferred from the seller to the buyer when the final installment is paid. Now this will take so many years. For example, if you have taken a hire purchase for an asset and it has to be paid within 10 years, do we have to wait for 10 years for us to recognize the asset in the books of accounts, or can we recognize the asset in the books of accounts in advance before we pay the final installment? And this is where substance over form comes in. So in accounting, we recognize the substance or the economic reality and not the legal form. So we ignore the legal form in this case and we recognize the substance. So long as we are the ones using the property, so long as this machinery is in our usage and we are honoring the terms of the contract, then we are going to recognize the machinery as an asset. So we recognize the substance over the legal form. And we even charge depreciation on the asset as we await the 10 years to expire and we finish paying the final installment. So that is what we mean by substance over form. You recognize the substance or the economic reality and not the legal form. So the next one is duality. Duo means two. So this one is simple. It simply means that for every accounting transaction there is a dual effect. That is, there is a debit and a credit. So every transaction in accounting has to have a debit and a credit. That is what we mean by duality. And we have to ensure at all times as we are recording, we make sure we have recorded the debit in the relevant account and the credit in the relevant account. So the next thing we are going to look at is the modifying constraints. Now, if we want to follow all the principles blindly, a lot of problems maybe may arise. So there has to be put some breaks in terms of putting up some modifying constraints. So these ones, they stop the accountant from following all the rules blindly. So the convections, or what we call the modifying constraints, one of them, the first one, is cost benefit. Now, for example, just because I said there has to be full disclosure, does it mean if it's a limited company and they have to publish the financial statement, does it mean they have to buy the whole newspaper in that day so that they can publish all the information? Does it mean that they have to give us all the nitty-gritties at the expense of the cost of providing that information? Of course, that is not what it means. The benefit of the information has to outweigh the cost. So when you are presenting information, publishing it, always the benefit has to outweigh the cost. So we have to do what we call cost-benefit analysis. Again, that is simple to understand. The next one is conservatism or prudence. This one requires that accountants are prudent or conservative to ensure they do not overstate the worth of the assets, neither should they understate the liabilities. In lieu of this constraint, we have to make certain provisions. Like for example, when we foresee that there will be a loss, like some of the debtors will not pay, we have to make a provision for doubtful debt. It is in line with this prudence concept or conservatism concept, whereby we have to be guided in our forward looking, so that if we foresee a loss, we make a provision for it early enough. So prudence ensures that we do not overstate the worth of the assets, neither should we underestimate our liabilities. Finally, amongst the modifying constraints, we have what we call materiality. Commonly, people would mistake this to mean something to do with materials, but it is not. Materiality, I would start by an example whereby I don't know how much if a sole proprietor, probably a shopkeeper, in preparing their financial statement, they have made an error. Maybe they have understated the profit by 10,000. We would say that error is very material. That is, it can be misleading for us to believe maybe they are more profitable than they are. But if we look at the big giants like probably the telecommunication companies, if they have made an error in their financial statement, probably underestimated profit by 10,000, we would say that that error is immaterial, because for example, if they are making profits in terms of billions, what is 10,000 compared to billions of their profit? But for a shopkeeper, 10,000 is a big magnitude of an error, because their profit margin is also very small. So if a shopkeeper makes an error of 10,000, we would say it is material compared to their net worth. But if a giant telecommunication company has made an error of 10,000 in their reporting, we would say that the error is immaterial. So materiality, it focuses about the net worth of your business in comparison to what the error is. So if something is immaterial, it is too small to affect the decision makers. But if it is big, we say it is material. It is capable of influencing decision making. So materiality is about the size of a transaction in relation to your assets, in relation to your profits, in relation to your net worth. The same way, There's somebody who, if they lose maybe 10 shillings, much more. So to them, the 10 shillings is immaterial. But to someone else who is hustling, losing the 10 shillings in the matatu would result in asking everybody to stand up so that probably they can look for that money because it is too important to them. It's all maybe they have. So materiality is about... Okay, so having finished on the modifying constraints, let us look at the review questions. So our first question would be, give us an example of a situation where two concepts clash and explain how this can be resolved. I may give an example, for example, where full disclosure and materiality, they can clash because in some circumstances, while one principle is saying that you should disclose everything, the other principle, materiality, is saying that if an error is too small to affect decision making, then we can continue without worrying about such small errors. So that is an example, but in this case we say that materiality takes the day. So another example or another question is you define the following accounting principles or concepts. So for this one you can do, because we have explained them. You can talk about what is going concern. We have said it is about continuity of the business into the foreseeable future. Historical cost, it is recognizing assets at their historical cost, the amount of money that was used to acquire them. Materiality, I will not dwell on it again, we have overdone it. Revenue recognition. And finally, our another question would be, explain the need for accounting theory as incorporated in the conceptual framework. Why do we need the accounting theory? So one of the reasons is to increase the user confidence in the financial statement. Users are more confident when they know that accounting is guided by similar principles. Again, it helps people to do the same thing, that is standardization, so that different organizations do not report differently. Rather, there is one common way of doing things among many others that can be the reasons or the need for the accounting theory. So that is the end of my presentation. I hope you found it important and useful. So kindly like, share and subscribe to my channel. Thank you.